Hello everyone. Thank you for coming to my channel. Today the paper I would like to read is Inflation Targeting, a New Framework for Monetary Policy. This paper is written by Ben Bernanke and Frederick Mishkin. First, I would like to talk about the inflation targeting. So it is a new way of conducting monetary policy. So the monetary authority will target a certain level of inflation. So if the inflation rate is higher than the target, then the Federal Reserve would increase the interest rate. And if the inflation is lower than the target, then the Federal Reserve will implement the expansionary monetary policy. So in this way, this inflation targeting rule provide a general guidance for the conduct of monetary policy. So let's begin for today's reading. The world's central bankers and their staffs meet regularly in venues from Basel to Washington to share ideas and discuss common problems. Perhaps these frequent meetings help explain why changes in the tactics and strategy of monetary policy making, such as the adoption of money growth targets in the 1970s, the intensification of efforts to reduce inflation in the 1980s, and the recent push for increased institutional independence for central banks, tends to occur in many countries more or less simultaneously. Whatever their sources, major changes in the theory and practice of central banking are of great importance for both individual countries and the international economy. In this article, we discuss a new strategy for monetary policy known as inflation targeting, which has sparked much interest and debate among central bankers and monetary economists in recent years. This approach is characterized as the same suggested by the announcement of official target ranges for the inflation rate at one or more horizons, and by explicit acknowledgement that low and stable inflation is the overriding goal of monetary policy. Other important features of inflation targeting include increased communication with the public about the plans and objectives of the monetary policy makers, and in many cases increased accountability of the central bank for attaining their objectives. Inflation targeting in various forms has been adopted in recent years by a number of industrialized countries, including Canada, the United Kingdom, New Zealand, Sweden, Australia, Finland, Spain, and Israel. Table 1 offers some details about the specific plans in each country. There are also important elements of inflation targeting, as we discussed below, in the long-standing and well-regarded monetary policy approaches of Germany and Switzerland. In the United States, inflation targeting has been advocated by some influential policymakers, and Senator Conor Mack has introduced a bill that, if passed, would establish price stability as the primary goal of monetary policy. Finally, the Maastricht Treaty mandates price stability as the primary objective of the European Central Bank, and it seems likely, if European Monetary Union in fact occurs, that the European Central Bank would incorporate major elements of the inflation targeting approach in its procedures. We begin our discussion of inflation targeting with some details of how this approach has been implemented in practice. We focus on the practice of inflation targeting rather than the theory, because we believe that the rhetoric associated with inflation targeting is often misleading. In particular, we will argue that actual experience with this approach shows that inflation targeting does not represent an ironclad policy rule, as some writers on the subject and even some advocates of this approach seem to assume. Instead, inflation targeting is better understood as a policy framework whose major advantage is increased transparency and coherence of policy, and in which fairly flexible, even discretionary monetary policy actions can be accommodated. We next discuss in more detail why viewing inflation targeting as a framework rather than a rule blunts some of the arguments that have been made against it, and in general enhances the appeal of this approach. This is not to say that valid questions do not remain about this strategy for monetary policy. In the final portion of the paper, we discuss some important additional issues and draw conclusions about the usefulness of the inflation targeting framework. The inflation targeting in practice, although every country that has adopted inflation targeting has customized the approach in various ways, certain empirical generalization about this strategy can be made. The hallmark of inflation targeting is the announcement by the government, the central bank, and some combination of the two that in the future the central bank will strive to hold inflation at or near some numerical specific level. As can be seen in Table 1, inflation targets are more often than not specified as ranges. For example, 1 to 3%, rather than single numbers, and they are typically established for multiple horizons ranging from 1 to 4 years. However, there are exceptions to both observations. Indeed, Germany, with the longest experience of inflation-focused monetary policy, specified its implicit inflation target as a point and only for a one-year horizon. Initial announcements of inflation targeting generally allow for a gradual transition from the current level of inflation to a desired steady-state level. Usually, the level deemed consistent with price stability. Price stability never in practice means literally zero inflation, however, but usually something closer to a 2% annual rate of price change for reasons we discuss later. There is a lively debate over whether targeting should be of the interest rate per se or of the price level. Of course, a targeted price level need not remain constant indefinitely, but could be allowed to drift upward in a predetermined way over time. The relative disadvantage of targeting the inflation rate is that unanticipated shocks to the price level may be treated as beguns and never offset. As a result, forecasts of the price level at long horizons might have a large variance on the inflation targeting, which presumably impede private sector planning. On the other hand, strict price level targeting requires that overshoots or undershoots of the target be fully made up, which reduces the variance of long-run forecasts of prices, but could impart significantly more volatility into monetary policy in the short run. In practice, central banks tend to compensate partially for target misses, particularly at short horizons. Associated with the announcement of inflation targets, there is usually some statement to the effect that control of inflation is a primary or overriding goal of monetary policy and that the central bank will be held accountable for meeting the inflation targets. For example, Section 8 of the Reserve Bank of New Zealand Act of 1989 assigns the central bank the, the statutory responsibility to formulate and implement monetary policy directed to the economic objective of achieving and maintaining stability in the general level of prices, with no mention of competing goals. Section 9 of the Act requires the Minister of Finance and the Governor of the Reserve Bank to negotiate and make public a policy targets agreement, setting out specific inflation targets. In other countries, such as Switzerland, Canada, and the United Kingdom, the inflation goal is embedded in public statement by the central bank rather than mandated by law. The rationale for treating inflation as the primary goal of monetary policy is to clearly strongest when medium to long-term horizons are considered, as most economists agree that monetary policy can affect real quantities such as output and employment only in the short run. Of course, some economists of new classical or monetarist persuasions might claim might claim that inflation should be the sole concern of monetary policy in the short run as well, arguing that using monetary policy for short-run stabilization of the real economy is undesirable, infeasible, or both. However, in practice, no central bank has of yet completely foreseen the use of monetary policy for short-run stabilization, and for the phraseology primary or overriding must be taken to refer to the longer term. The degree to which the central bank is held formally accountable for inflation outcomes varies considerably. The New Zealand law links the tenure of the governor of the Reserve Bank to the achieving of the inflation targets, and thus comes closest to providing an explicit incentive contract, as proposed by Person and Tablini and Walsh. In other countries, no explicit sanctions on the central bank for missing the target are given. Presumably, however, missing the target badly would impose implicit institutional or personal cost in terms of lost reputation or prestige. It is rather early in many of the inflation targeting experiments to judge the extent to which the prospective penalties for missing announced targets will constrain uh, central bank behavior. Despite the language referring to inflation control as a primary objective of monetary policy, as we have said, inflation targeting central banks always make room for short-run stabilization objectives, particularly with respect to output and exchange rates. This accommodation of short-run stabilization goals is accomplished through several means. First, the price index on which the official inflation targets are based is often defined to exclude or downweight the effects of supply shocks. For example, the officially targeted price index may exclude some combination of food and energy prices, in, indirect tax changes, terms of trade shocks, and the direct effect of interest rate changes on the index. Second, as already noted, inflation targets are typically specified as a range. The use of ranges generally reflect not only uncertainty about the link between policy lever and inflation outcomes, but is also intended to allow the central bank some flexibility in the short run. Third, short-term inflation targets can and have been adjusted to accommodate supply shocks or other exogenous changes in the inflation rate outside the central bank's control. A model here is the Dutch Bundesbank's practice of stating in short term, like 1 year, inflation projection as a level of unavoidable inflation. In the aftermath of the 1979 oil shock, for example, the Bundesbank announced the unavoidable inflation rate to be 4%, then moved its target gradually down to 2% over a 6-year period. In other cases, the central bank or government makes explicit an escape clause, which permits the inflation target to be suspended or modified in the face of certain adverse economic developments. In making inflation a global variable, the focus of monetary policy, the inflation targeting strategy in most cases significantly reduces the role of formal intermediate targets, such as the exchange rate or money growth. To the extent that intermediate targets are used, it is emphasized that the inflation goal takes precedence in case of conflict. Unconditional commitment to an intermediate target is of course inconsistent with inflation targeting, except in the unusual case that the intermediate target effectively summarizes all current information about inflation at the forecast horizon. The fact that in most countries the relation between intermediate targets such as money growth and the central bank's goal variables has proven to be relatively unreliable. The so-called velocity instability problem is a major motivation for dropping formal intermediate targets and instead attempting to target the goal variable directly. On the other hand, since targeting inflation directly requires that the central bank some forecast of the likely path of prices, close attention is typically paid to a variety of indicators that have shown predictive power for inflation in the past. For example, as an aid to inflation forecasting, monetary policymakers in Canada and Sweden make use of a monetary conditions index, a weighted combination of the exchange rate and the short-term interest rate, in conjunction with other standard indicators such as money and credit aggregates, commodity prices, capacity utilization, and wage developments. In most inflation targeting regions, the central bank publishes regular, detailed assessments of the inflation situation, including current forecasts of inflation and discussions of the policy response that is needed to keep inflation on track. A good example is the Bank of England's inflation report, published quarterly, which contains detailed analysis of factors likely to affect the inflation rate, as well as probabilistic forecasts of inflation, assuming no change in interest rates. The central banks of Canada and Sweden release similar documents, and the Reserve Bank of New Zealand is required to issue a policy statement at least every 6 months. As we discuss further below, the use of such reports reflects a key objective of inflation targeting, which is improved communication with the public about monetary policy, its goals, and in particular, the long-run implication of current policy actions. The adoption of inflation targeting is often linked with changes in the laws or administrative arrangements associated with the central bank. Typically, reforms are in the direction of increased independence for the central bank, particularly in respect to its choice of instrument settings. This seems to be a logical consequence of making price stability the overriding goal of policy, since the central bank is the best place to make the technical decisions necessary to achieve price stability and to make judgments about whether the pursuit of other objectives is consistent with its goal. Exceptions to this observation are the United Kingdom and to a lesser extent Canada, where despite the commitment to inflation targeting, the government rather than the central bank retains the final control over monetary policy. However, even in the British case, the adoption of inflation targeting seems to have increased the relative influence of the central bank, as the inflation report and the timely publication of the minutes of the monthly meeting between the governor and the chancellors of the exchequer provide an independent forum for the bank to express its views. In effect, the government must rationalize for the public any deviations of its policies from those recommended by the bank. More, more or all of the characteristics of inflation targeting described in this section apply to countries adopting this approach within the last 8 years or so. As noted in the introduction, this includes Canada, the United Kingdom, New Zealand, Sweden, Australia, Finland, Spain, and Israel. Germany and Switzerland, which have conducted inflation-focused monetary policies since the mid-1970s, are better viewed as hybrid cases, which meet some but not all of the above criteria. These two countries differ from the pure inflation targets primarily in their greater focus on monthly growth as an intermediate target, and indeed, the Bundesbank has emphasized the superiority of money targeting as a means of ensuring monetary discipline and transparency. In fact, many observers, including ourselves, would argue that the distinction between inflation and money targeting is overstated, and that monetary policies in both countries are driven in the medium and long term primarily by inflation goals. For example, the Bundesbank's money growth targets are derived using the quantitative equation to be consistent with an annual inflation target. Even projections of the growth of potential output and of possible changes in the velocity of money. This inflation target, in turn, has brought down steadily over time and has remained at 2%, the level deemed consistent by the Bundesbank and price stability since 1986. Further, the Bundesbank has shown itself quite willing to miss its money targets when pursuing these targets threatens to conflict with the control of inflation. All in all, the philosophy guiding German and Swiss monetary policies seems relatively consistent with the one motivating the self-declared inflation targeters. The main practical difference between the two sets of countries is that the Germans and Swiss believe that the velocity of money has been relatively more stable in their countries, and so they view money growth targeting as a useful tool for implementing their inflation objectives. It is also true that Germany and Switzerland have been less explicit in stating their inflation targets. Neither central banks publish a regular inflation report per se, but this distinction seems relatively unimportant. Inflation developments receive prominent attention in the regular publications of both banks. Moreover, there may be less need for public declarations given the long-standing commitment of the Bundesbank and Swiss National Bank, and the popular support for that commitment to price stability. The examples of Germany and Switzerland are important because unlike the other countries mentioned, these two countries have been following their monetary policy strategies fairly consistently for more than 2 decades, rather than for only a few years. Thus, their experiences may provide researchers attempting to assess the value of inflation-focused monetary policy with useful information. Thank you for listening to my today's reading. It's quite a lengthy one, but I hope you can learn something from it. Thank you very much and see you tomorrow.